Growth in Chinese travellers is spurring optimism about the region's tourism-related companies, including hotels and M&A activity.
This typically supports the Asia-Pacific region's performance and valuation lead. Intercontinental Hotels Group is one such company using M&A to scale up. Joining us now from Berlin, ahead of the ITB Berlin conference, it is the CEO, Keith Barr. Keith, good to see you this morning. You're there in Berlin. Give us a sense of this gathering. What's the big theme? Is the confidence? We've got the confidence in Davos in terms of the global economy. Is that prevailing across your industry gathering there?
Yeah, without question, it's great to be here in Berlin at IHF and ITB, and you're really seeing that confidence that you heard so clearly at Davos head over into the hotel sector. Having dinner last night with owners from around the world, you're seeing their belief in investing in real estate and in hotels across the entire sector, and you're really seeing that acceleration of growth, which we're so focused on here at IHG, of launching new brands and taking our existing brands into new markets. So a real general positive sentiment overall.
Keith, concerns about a global trade war have been rattling markets in recent days, although we're seeing a little bit of a relief rebound today. Could there be any impact on your business if we do get a full-blown trade war? And where would it come from? Would it be a slowdown in China or elsewhere?
Anytime there are impact on business on a global basis, that has an impact on this industry, but it's an incredibly resilient industry. When you look at over the past 20 years, we've only seen really 2 downturns, and those came because of macro events such as 9/11 and the financial crisis too. And the business then quickly came back. So overall, we think that's a very resilient business, but of course, any macro events like that would have a short-term impact because of business travel and investment in infrastructure and so forth. But you have economies going from strength to strength. I was recently in China, and you're seeing some of our top revenue growth happen in that market. It's a third of our company's growth. You're seeing an acceleration in the latter portion of the U.S. as well, and continued recovery across Europe in places like Turkey and France, and growing in the U.K. as well too. So generally, real kind of positive momentum across the business, but that can always be at risk if there's a big event.
Keith, obviously, the last time we caught up with you, you delivered your results. The stock dropped the most in 17 months. And there is this debate in the market about you obviously bypassing the special dividend and going for M&A. That was your message to the market. The market punished the stock on the day and would seem to perhaps take a little bit of umbrage. I mean, you've got a number of analysts saying that you could have paid a special dividend and still remain within the leverage ratio. You probably say to me, Manus, I don't respond to one-day stock movements, but respond to the market's angst.
Yeah, well, since then, of course, we've come back quite strongly. And my conversations that week with our shareholders were our commitment to focus on accelerating our growth around the world. So our core use of cash has been invest in the core business and maintain our ordinary dividend and grow that, which we've done more so and better than any other company in the industry for the past decade. And then when we have surplus cash, make sure we return that to shareholders. And our commitment to that is continuing. But this year, we're very focused on accelerating our growth, so we're launching new brands. So we have a new brand in the United States. We've launched Avid Hotels, which took place in September, and we now have already 75 hotels signed. And we recently announced that we'll be launching 2 new brands this year, effectively a conversion brand starting off here in Europe, and also looking to acquire a luxury brand too. So, we're really investing for growth, and that's what our shareholders want. They want to make sure that we have a brand portfolio that meets customer and owners' needs. They can take advantage of those opportunities so we can accelerate and have sustainable growth, not just returning cash in the short term.
Keith, you've said you're looking to acquire luxury brands. Any in particular that you're targeting?
Well, I can't. If I name them, the price would probably go up today. But very, very focused on acquiring luxury brands.
Generally, where are you looking?
Unique. Yeah, across Europe and Asia, there are a number of very small luxury brands that have a really unique customer proposition that they haven't had the ability to scale up globally. Some of them have been around for a while, have great heritage, but they're constrained by their ability to invest in technology, ability to invest in resources to go globally. So IHG acquiring one of those brands, really nurturing it and growing and expanding it is going to be critical to our success to grow in luxury above Intercontinental, which today is already the world's largest luxury hotel brand.
Just in terms of valuations and where you look, unfortunately, we're at a slight disadvantage. I've grabbed together some data from our Bloomberg intelligence team who are looking at enterprise value in Asia relative to the US, relative to the European peers. And they basically are saying enterprise value to EBITDA in Asia. It's trading around 15 times, which is obviously far in excess of the US and the European peers. Do you think that this is an expensive market to do M&A in terms of Asia, which many people are saying should and will be your focus?
You know, we're seeing great growth across Asia, across all of our brands, but we're very, very disciplined in our use of capital and making sure that we can acquire a luxury brand at the right price point. You know, I said very publicly, we're not going out there to do a huge deal at a huge multiple, which is really can be damaging to a return on capital. Being very focused on acquiring something that we know we can really incubate and grow, and there's a good strategic fit for us. And the Europe business is quite strong, and the Asia business is exceptionally strong because of the future growth in that pipeline across resorts, across mainstream, and again, accelerating growth in places like China, but Vietnam is really doing exceptionally well. So it's an exciting part of the world, and you're seeing just more interregional travel flows. And you mentioned China earlier on. I think they've just recently surpassed now as the world's largest outbound travel market, and we're yet to see even more to come there, too. So it's a great place to be invested in, and our history and our heritage in Asia is exceptionally strong.
Keith, you've said before that digital will be the big differentiator between the larger and smaller players in your industry. What could we see from you in terms of digital deals?
You know, it's fundamental that the industry is becoming more dependent upon digital, and what's actually driving consolidation in the industry is the big companies' ability to invest in technology, invest in central reservation platforms, mobile applications, digital marketing, data analytics, and so forth. The small companies can't afford to do that, so the industry will continue to bifurcate. The big hotel companies will get bigger. The big five today have 20% of the existing branded pipeline, but 60% share, but 60% of the pipeline. The industry is becoming more branded because of our ability to invest in technology. So we have a new central reservation platform launching this year, already in 200 hotels, and will be all of our hotels by early 2019, which will step change our ability to price and how we market and distribute our hotel brands. And you'll see more and more things in that nature where the big companies are investing in digital and new technologies to strengthen the customer proposition, but also drive more revenues and profits to our hotels.
Keith, I want to just pick your brains a little bit. We have this story this morning. It's the front of Bloomberg, the front of the FT, that the UK and the US have had secret open skies discussions in January. The UK walked away. It looks like the US is offering potentially a worse deal. If you take that, if you take the consumer confidence, how is the UK holding up? What are your numbers like in the UK? And is Brexit in any way precluding you from directly investing in the UK?
Yeah, so today the UK is about 5% of our business globally, and we had some very solid results last year in the UK, both in terms of revenue growth and also new hotel development. I had a number of conversations just last night about owners who want to invest and build hotels in the UK. It is such an exceptional market, a great destination. Of course, though, anytime there's uncertainty, business does not like uncertainty. And so, you know, we've been engaging with the government to talk about understanding what's going to be the impact on employment. And you're seeing a real focus on that, making sure that we have the ability to grow our business there, because hospitality and tourism is a great creator of jobs and a great growth commitment to GDP. So overall, Brexit is uncertain. You know, I'm speaking to my peers in other industries who are not confident in understanding exactly what they should be investing in. We benefit from both domestic travel, but international travel as well, too. So candidly, with the pound having become, you know, depreciated a bit over time, it's made the UK even more attractive for international inbound. So we saw an uptick of travel last year and strengthening performance. So overall, not a big impact on our business, but we hope to have more certainty going forward soon.
Yeah, everyone's looking for certainty, Keith. Let me just go back to the question about returning capital to shareholders. We talked about the special dividend, and we did also hear from Accor a few days ago. They're going to do a $1.65 billion share buyback, and this is about their move as well of becoming asset light, as I know you are as well. We've talked about the special dividend. Would you consider any share buybacks in the next year or two?
You know, our strategy has been very, very consistent. We've returned about $13 billion to shareholders through ordinary and special dividends since we became a standalone company over the last 13, 14 years. And that commitment remains. Fundamentally, we will invest for growth in this business, and then when we have surplus cash, we'll return that to shareholders. We've principally done that through special dividends in the past. We have done some share buybacks. We have to do what makes the most sense for creating long-term value for our shareholders and making sure though, that we are kind of continuing to invest in this business, which has so much potential to continue to grow globally, also in the UK and throughout here in Europe.